Welcome to Stat Plus, where we enable smarter conversations wherever you go. In today's video, we're exploring how Japan's interest rate hikes have triggered a major shift in global capital flows, contributing to India's stock market correction. One of the driving factors behind India's stock market correction since October 2024 that is largely overlooked in public discourse is the change in Japan's monetary policy and subsequent interest rate hikes by the Bank of Japan. Even as India's benchmark Nifty index attempts a recovery, it remains approximately 9% below its all-time highs, underscoring the depth of the recent volatility. For over a decade, Japan maintained ultra-low, even negative interest rates amid an aging population and declining workforce. This unconventional policy was designed to encourage domestic spending and investment. It also created the perfect environment for what financial experts call the carry trade, a strategy where investors borrow in low-interest currencies like the yen to invest in higher-yielding assets elsewhere, including the Indian markets. Japan's zero-interest rate environment encouraged such investments, which could be initiated at zero capital cost. However, by 2024, with concerns mounting about the weakening yen and low economic growth, Japanese monetary authorities began reversing course. The Bank of Japan has implemented 3 rate hikes over the past 12 months, systematically raising rates from -0.1% to 0.5%. These hikes occurred in March and July 2024, with the most recent one in January 2025, marking Japan's definitive exit from its negative interest rate policy era. When interest rates begin to rise, these carry trades become increasingly unprofitable as borrowing costs increase, triggering widespread unwinding of positions. By September 2024, Japan's external assets had reached a staggering $11.3 trillion, creating an enormous pool of capital that had found its way into global markets. The scale of this shift becomes apparent when examining Japan's external asset positions. September 2024, $11.3 trillion or 1.58 trillion yen at 140 yen per dollar. December 2024, $10.5 trillion or 1.67 trillion yen at 158 yen per dollar. The October-December 2024 period witnessed intensive carry trade unwinding, with the USD value of Japanese external assets dropping by $741 billion, that is 6.57%. The Bank of Japan's latest rate hike in January 2025 triggered another sharp market reaction, resulting in a further 6% drop in the Nifty within just a month. Direct Indian exposure to Japanese investments stands at around $180 billion. However, when considering indirect investments routed via financial hubs like Singapore and Thailand, India's actual exposure likely approaches the trillion-dollar mark, inclusive of equities, highlighting the interconnectedness and complexity of global capital flows. Notably, the recent recovery in Indian markets after mid-March also coincides with the BOJ's decision to hold off on a further rate hike in their March meeting. FDI outflows have also cooled off since then. This phenomenon has therefore been a significant contributing factor to the ongoing market correction, alongside more visible pressures such as US-India trade tensions, underwhelming corporate results, and other domestic economic factors. As global monetary conditions continue to evolve, understanding these interconnections becomes increasingly crucial for investors navigating India's financial markets. Now let's hear from you. Do you think Japan's monetary policy will continue to impact India's stock markets? Or is the worst already behind us? Let us know your thoughts in the comments below. Thanks for watching. If you found this analysis insightful, please like, share, and subscribe to Stat Plus for more updates. Whether you're at work, school, the gym, or catching up with friends over coffee, our content empowers you to contribute meaningfully to conversations on a wide range of topics. Have better conversations wherever you go.